Matt Tucker, Head of Fixed Income for iShares. What is on your mind, sir?
Well, today I want to talk about inflation. I know in a prior posting, Kevin Nefsey presented a framework for thinking about inflation.
The teeter-totter, right?
Exactly, the teeter-totter and the big hit in the economy and the balance there. What I want to talk about today is how investors can actually observe what the market believes inflation is going to be in the future. And to illustrate this, I'm going to use two different securities in the market. One is called a TIP. It is a Treasury Inflation Protected Security issued by the U.S. Treasury, and it's a security that actually pays you out a return that's partly made up of inflation. And if you look at that security today, you'll see a security which has a yield of about 80 basis points. And there's a second security you can look at if you look at a 10-year nominal Treasury, like we might see quoted in the Wall Street Journal or online somewhere. And that's going to pay you a rate right now of about 3.4%. And so these are the two securities you can look at, and one pays you out something for inflation and one does not. And the key about these two securities is the difference between them represents what the market believes inflation is going to be. So right now the market thinks inflation is going to be about 2.60%. And what's interesting is if you go back to a time, say, December of last year, you can actually see that the yield on TIPS was about the same at about 80 basis points. And the yield on the Treasury actually was lowered about 3%. So the market then in December expected inflation at about 2.2%. So what's happened in the last couple months as investors have changed their outlook about not just inflation, but also about the economy and the recovery, is they have increased essentially the implied inflation rate, the expectation about inflation. And what I think is really interesting about this is that through all of this noise the last couple months, the actual kind of real interest rate where people actually price treasuries hasn't really changed. So it's not so much about how risky you think the treasury is, or whether you think that rates are going up and down, or the balance of supply and demand in the treasury market. It's really about your expectations about the inflation rate that have changed. And this is a reflection really, I think, of not just input prices like gold and oil and gas, which we all see every day, and those have been rising, but also embedded in here is an expectation about the economic recovery and what we might be seeing in the future. And essentially, the market is more bullish about the potential for recovery, and therefore an increase in jobs, increase in purchasing power, and an increase in prices that we all experience every day.
So really the question posed to our viewers is
how do you feel about the recovery? And where do you think we're going next? 2.6% is actually a relatively high inflation rate by historical standards, and that reflects actually a pretty aggressive view on the behalf of the market about the strength of the recovery and where we might go over the next 10 years.